Welcome back to Gecko Finance channel. I'm Artie and let's go. Today we are going to travel. I know you've missed it. So we are going to travel and explore. What are we going to explore, you might ask? We are going to explore the wonderful world of investment tools. There is a large number of securities represented on the market and it's like a buffet. Some dishes will taste good and the others will give you diarrhea. How to choose? Let's figure it out. The first dish on our menu are shares, the juiciest and the tastiest one. What is a share? Share is a part of a company. If you buy a share, you are entitled to its profits through dividends. You can also participate in management of the company. Person who buys shares is called a shareholder. There are two ways of making profit through shares. First one is getting profit of the company through dividends, and the second way is selling your shares if they grow in price. And one way of making profit does not exclude the other. For example, you can make your profit through dividends and then sell the shares if they rise in price. What is a dividend? Dividend is a share of profit that company distributes to its shareholders. It can be distributed on the results of 1 year, half a year, quarter of a year, and etc. Or it may not be redistributed at all if it's the decision of shareholders or if it's company policy. If company's net profit is $10 billion and if company's share capital is 100 billion share, then if the shareholders decide to pay all the profit in form of dividends, each share will have 10 cents of payments. When choosing a company's shares for investment, you need to pay attention to several things. You need to pay attention to whether they pay dividends, how often they pay them, and in what amount. How much can you make on dividends? You need to pay attention to the dividend yield. If the company's dividend yield has been stable for many years, it means that the stock price will tend to be more stable. Why do share prices rise? If a company makes profit, does not spend it, but saves it up in accounts, then it can be later redistributed among the shares. Also, if a company spends money on business development and it's able to make more and more profit, then share prices will also raise. And if a company operates poorly, the investors will see that it has no potential, then there will be no profit accumulated in shares, and then their price will fall. There is no universal way to decide the fair price of the stock. Each investor decides for themselves if the current price is correct and how it should change in future. How can you make money on the growth of shares and company capitalization? You sell the shares. Let's say you buy a share that costs $50 and then its price rises to $100. You sell the share and you get $50. That's your profit from company's capitalization. As long as the shares are not sold, there is no income. They're just paper or unrealized profit. Because if you bought shares at $50 and today they are worth $100, tomorrow they may cost $25. There you go. That brings us to the next point, the risks. What are they? The first risk is not getting dividends. If a company makes no profit, it may decide not to pay any dividends and you get no income, you get no money. Sad. Second risk is selling shares at a loss, because shares cannot only grow in price, they may fall in price. And that's affected by many factors. Company's performance, government policies, coronavirus, etc. And well, you buy a share for $50 and then it drops down to $5. You sell it, you lose money. Simple and sad. You can lose money if the company goes bankrupt, because shareholders are called creditors on the last turn. They will only get their money after the company pays its salaries, it pays all its debts, and etc. And you're the last one to get your money. There is a high percentage chance that you will get nothing. Share prices can drop to zero, so therefore it's very risky to invest all your money in shares. And it's even more risky to invest all your money into shares of one company. You can lose all your money. Let's sum it up. Investing into shares requires ability to predict the future, because stock prices grow up and drop to zero pretty unexpectedly, so it's pretty risky to invest into shares. Risk level 7 Gecko points out of 10. Pretty risky, but you gotta risk it for the biscuit. The second item on our menu is bond. Not James Bond, just bond. Bond is debt security. A bond gives the holder a right to get interest from the debt and also get the full amount of it by maturity. Bonds sound a lot like bank loans, but unlike bank loans, they can be sold and bought. If you buy a bond, you are entitled to get interest from it, and you also get the nominal value by its maturity. And if you sell the bond, the next owner will be entitled to the interest and the nominal value by its maturity. For example, a supermarket chain needs $200 million for 5 years to build new stores, and it is willing to pay 10% per annum. It can apply for a loan from a bank, or it can issue 20 million bonds with a face value of $100 and coupon rate of 10%, and then just find investors who are willing to buy those bonds. Why is the bond price is not always equal to par, and how does it affect the yield? The price is different because the yield to maturity is regulated by the change in price. If people want more yield, they offer a lower price. You can make money on the difference between the face value and the price of the bond. For example, if the face value is $100 and the actual price is $97, you can make $3, and vice versa. If the face value is $100 and price at the moment is $103, you lose $3. But the price above nominal value does not mean that the yield of the bond to maturity will be negative. In addition to the yield, because of face value and the price, there is also coupon income. What does the bond yield consist of? The yield to maturity consists of coupon yield and the difference between the bond price and its nominal value. The difference between bond price and nominal value can be positive or negative. Accordingly, it decreases or increases the yield. What is coupon income? Coupon income is interest of payments on bonds. It can be fixed, floating, or some bonds may not have coupons at all. The dates of interest on the bonds are known in advance. What risks do bondholders face? What is the default? Well, the risks are not making profit, working at a loss, and in very rare cases, losing all the money invested. From the issuer's point of view, a bond is a debt, an obligation to pay money to the bondholders. And if they don't have money to pay them, they may end up being in debt or, in some cases, going bankrupt. How can you make money off bonds? You can make money on coupon rates and on change of the value, but those are pretty rare, so I wouldn't count on them. Basically, it's like a bank deposit. Our risk level is 3 Gecko points out of 10. The last thing for today, instead of dessert, funds. An exchange-traded fund, ETF, are certain assets that can be sold or bought on an exchange. Usually, they are shares or bonds, but sometimes they can be commodities like coffee, oil, etc., etc. The funds may invest in stock in the largest companies in specific countries or regions. The assets of the funds, as a rule, consist of hundreds of securities collected in accordance with the indexes. What are indexes? They are rules that dictate which securities to buy and in what proportions. Indexes are developed by exchanges, investment banks, and special organizations. To put it simply, if you buy one share of the fund, you invest into a lot of different companies, albeit at a very small percentage. If you buy a share of the fund, you will invest into a lot of different companies, but you will get only a microscopic share. For example, the investment fund of the US Broad Market Index, FXUS, allows you to invest in 624 major American companies. Oil, American cars, hypermarkets, military, everything. You will get a small share in each of them if you only buy one share of the fund. What are the advantages of ETFs? That is the most affordable and secure way of investment for a private investor. Funds allow you to invest in a wide range of securities with very little capital. Funds remove the need to choose companies for investment independently. This is done by the compliers of the index. And last but not least, there are dozens and hundreds of securities in the funds. If any of them loses its profit or even goes bankrupt, you lose almost nothing because there are still all the other companies in the fund. If you buy an ETF, you buy very small pieces of the stock in a lot of companies, but you can only make profit on price changes. The risk is very low, but the reward is low as well. Our Gecko rating: 4 geckos out of 10. Very low risk, but not too much profit as well. Now you know the menu of our buffet, and it's completely up to you what you are going to eat. But remember, keep your diet balanced. In other words, diversify your investments. Your portfolio should include shares, bonds, and funds. And if you stick to that diet, you might become happy. And if you are really lucky, filthy rich. We like being rich here, don't we? That's it. Like, subscribe, comment, and ring the bell. Make money, multiply money, and be happy. And remember, happiness does not depend on money, but on its quantity. I'll see you next time. Bye-bye.